Welcome to a brand new deep dive. We're going to be going behind the scenes of the Indian equity market. And our roadmap for this is White Oak Capital's January 2025 Market Perspective Report. And trust me, there is a lot to unpack here. We're going to be talking about everything from those FIIs who seem to be pulling back their money to the rise of those so-called SMID cap stocks.
And let's not forget the age-old battle between value and quality investing. It's a very fascinating time to be looking at this market.
Absolutely. So why don't we just jump right in, and we'll start with something that every investor has to deal with, and that's volatility. I know for me, seeing those numbers jump around, it can be a bit unnerving. And this report doesn't sugarcoat the fact that the market's been on a bit of a roller coaster lately.
Well, yeah, it has been pretty lively. And it probably won't calm down anytime soon. That's just kind of how the equity market works. But the key takeaway here is that it's not about avoiding volatility altogether. It's more about understanding what's causing it.
Okay, that makes sense. So how do we even begin to make sense of all these swings?
Well, one way is to look at something called the BSE Sensex EPS, which stands for earnings per share. And it's basically a measure of how much profit companies listed on the Sensex are making for each share of stock. And over the past 5 years, this EPS has grown at an average rate of 17.1% per year.
Hold on, 17.1% every year for 5 years. That sounds pretty good amidst all this talk of volatility.
Yeah, it is. And that 17.1% figure that we just mentioned, that's what's called the key AGR, or compound annual growth rate. It's basically a way to smooth out those ups and downs and see the average growth over a period of time. Like you're taking a long-term view instead of just focusing on the daily roller coaster.
So even though we might feel a bit shaken up by the daily market moves, seeing consistent growth like that over time does give you a sense of, okay, maybe things aren't so bad after all.
Exactly. It shows that despite those inevitable bumps in the road, the market tends to climb upwards in the long run.
Right. That's reassuring to hear, especially for someone like me who's still getting in the hang of things. But you mentioned understanding the drivers behind these movements. So what exactly are we looking for there?
Well, one fascinating relationship the report highlights is between India's nominal GDP corporate earnings and the returns that you see on the BSE Sensex.
Okay, break that down for me a little bit. What's the connection there?
Essentially, from 1993 to 2024, India's GDP and corporate earnings both grew at a remarkably consistent rate of 12.5% CAGR.
Wait, so both the overall economy and company profits grew at roughly the same pace for over 30 years?
Yeah, that's right. A remarkably steady pace. And when you look at the returns from the BSE Sensex, including dividends, they clock in at a pretty close 11.9% CAGR over the same period.
Okay, I'm starting to see the link here. If the economy's doing well, companies generally earn more, and stock prices tend to go up.
Exactly. So this chain reaction. And understanding this connection, I think, can be hugely helpful for investors. Instead of just reacting to those daily market ups and downs, you start to see the bigger picture and think about the underlying economic forces that are shaping those movements.
That's a really powerful insight. It's like getting a glimpse behind the curtain and understanding the why behind the numbers.
Absolutely. And speaking of forces shaping the market, there's another player that we need to talk about: foreign institutional investors, or FIIs.
Ah, yes, those big institutional investors. I've heard they can really move markets with their decisions. So what does the report have to say about them?
Well, it highlights some pretty significant outflows, essentially FIIs pulling their money out of the Indian market between September and December of 2024 to the tune of $11.2 billion.
Yeah, $11.2 billion. That does sound like they're getting spooked by something.
It does, doesn't it? But the report puts this outflow into a fascinating historical context. It compares it to other major events that also led to FII withdrawals, like the 2008 global financial crisis, the U.S. credit rating downgrades in 2011, and even the COVID-19 pandemic.
Okay, so how does this recent outflow compare to those massive events?
While $11.2 billion on its own sounds huge, it actually represents a smaller percentage of the overall market value compared to those previous events. We're talking a 0.2% dip. During the global financial crisis, the outflow represented 1.5% of the market cap.
So maybe not a full-blown panic this time around.
Yeah, that's the interesting part. The report suggests that this might be a more calculated strategic move by FIIs. Maybe they're adjusting their investments based on global conditions or reevaluating their positions in the Indian market.
It makes you wonder what they see that we don't.
It certainly does. And while FIIs can definitely influence market sentiment, it's important to remember not to overreact to their every move.
Okay, noted. Moving on, there's this ongoing debate in the investing world that I'd love to get your take on. Quality versus value.
Ah, yes, the classic tug of war. Everyone wants to know which style reigns supreme.
Exactly. And the report highlights the recent resurgence of value investing. It seems like after years of quality leading the charge, value's been making a comeback.
It has. And the report even points to specific years where value outshined quality, like 2007, 2010, 2012, 2014, 2016, 2017, and then from 2021 to 2024.
That's a pretty convincing streak for value.
Yeah, it is. But it's important to remember that history doesn't always repeat itself in a predictable way. While value has had the upper hand lately, if you look back to 2005, quality has actually delivered stronger overall returns.
So is it a matter of timing, like catching the right wave at the right time?
You know, there's no one-size-fits-all answer. It really depends on your personal investment philosophy and how much risk you're comfortable with. Some investors prefer the consistency of putting their money in high-quality companies, while others are drawn to the thrill of hunting for undervalued gems.
It's about finding the approach that suits you best.
Exactly, and that's why it's so important to stay informed, understand the different forces at play, and make decisions that align with your own goals and risk tolerance.
Makes sense. And speaking of forces at play, we can't ignore the rise of those so-called SMID cap stocks. They've been attracting a lot of attention lately.
Yeah, they have. SMID stands for small and mid cap, basically companies with smaller market capitalizations than those giants everyone knows. And the report shows that their market share has been climbing steadily.
So why should we care about these smaller players?
Well, in December 2024, they hit a record high of 40.3% of the total market cap. That's a huge jump from their average of 33.1% between December 2020 and November 2024.
Okay, that is a pretty big leap. What's driving this trend?
Well, it could signal a shift in market dynamics, where smaller companies are gaining more prominence and influence. And there's potential for real returns here. The Nifty Small Cap 250 TRI index, which tracks these companies, had a phenomenal 2024, delivering a 27% TAGR.
Now, that's what I call impressive. What exactly is a TRI index, though? I've heard it mentioned, but I'm not quite sure.
Ah, good point. TRI stands for Total Return Index. It's different from a regular index because it factors in both the price changes of the stocks and the dividends that they pay out. This gives you a much more complete picture of the actual returns you'd get from investing in those companies.
So a TRI index is like looking at the whole package, not just part of it.
Exactly. It's a more holistic view of how an investment is truly performing.
Okay, I'm adding that to my mental investing glossary. I know a lot of our listeners are probably thinking right now, do I have any of these SMID caps in my portfolio? It's definitely got me thinking about it.
Yeah, it's definitely worth considering. Diversifying your portfolio and exploring different segments of the market can be a very smart move. And speaking of segments, the report puts a spotlight on two key sectors: financial services and healthcare.
Two heavy hitters in the Indian market. Let's start with financial services. I know that sector has been facing some challenges recently.
It has. The report acknowledges that financial services have been lagging behind the Nifty 50 TRI. In fact, this underperformance is the most pronounced it's been in the last 15 years.
Wow, 15 years. That's a pretty long slump.
It is. But here's the intriguing part. Despite this underperformance, the report also highlights that the Indian banking sector is currently in its healthiest state in a decade.
Hold on. How is that possible? Strong performance and underperformance at the same time.
It seems contradictory, but it comes down to looking at the fundamentals. Indian banks are showing improved profitability, strong net interest margins, which basically means they're making a good profit from the difference between the interest they charge on loans and the interest they pay on deposits. And they have low credit costs, meaning fewer loans are going bad.
So maybe it's a case of the market not fully recognizing the strength of the fundamentals yet? Like there's hidden potential waiting to be unlocked.
Yeah, that's one way to look at it. It suggests that there might be some undervalued opportunities within the financial services sector, especially for those who are willing to take a closer look.
Very interesting. Now, what about healthcare? That sector is often seen as a safe haven for investors, especially during uncertain times.
And there's good reason for that perception. The report emphasizes the remarkable long-term wealth creation potential of healthcare. The BSE Healthcare TRI, which is the index that tracks the sector, has delivered an impressive 16.8% ECAGR since August 2004.
That beats both the Nifty 50 and the Nifty 500.
It does, and here's another interesting tidbit. The healthcare sector doesn't always move in the same direction as the broader market. It's what we call low correlation.
So when the overall market is zigging, healthcare might be zagging.
Exactly. That can make healthcare a very valuable tool for diversification. It can act as a buffer to smooth out the ups and downs in your portfolio, helping you weather those market storms a little better.
I like the sound of that. Now I'm trying to decide which sector is more appealing, the potential turnaround story of financial services or the steady hand of healthcare.
Well, that's the beauty of investing, having choices. It all comes back to your individual investment goals and how much risk you're willing to take on.
Well, we've certainly covered a lot of ground in this deep dive already, from the volatility of the market to the power of FIIs, the quality versus value debate, those rising SMID cap stars, and now a closer look at financial services and healthcare. It's been quite a journey.
And we've only just begun. There's a lot more to explore in the Indian equity market. Stay with us as we delve deeper in the next part of our deep dive.
Welcome back to our deep dive into the Indian equity market. I'm really excited to continue exploring these insights from White Oak Capital's January 2025 report. And there's one trend I think that we can't ignore, the rise of passive investing. It's definitely shaking things up.
Oh, it has been a major force reshaping the investment landscape globally. And India is no exception. It's a fascinating shift.
So for those who might be new to this idea, can you explain what passive investing is all about? I mean, I have a general idea, but would love to hear your take on it.
Of course. Passive investing is basically a strategy where you aim to match the performance of a particular market index, like the Nifty 50 or the BSE Sensex. Instead of trying to pick individual stocks or outsmart the market, you're essentially going with the flow.
So instead of trying to beat the market, you're trying to be the market.
Yeah, that's a great way to put it. You're not trying to pick winners and losers. You're simply accepting the market's overall performance.
And how do you actually go about doing that? Is it as simple as just buying a bunch of stocks?
Well, the most common way is through index funds or exchange-traded funds, ETFs for short. These are investment products that hold a basket of stocks that mirror a particular index. So when you invest in an index fund or ETF, you're instantly diversified across all those companies in that index.
So it's like one-stop shopping for instant diversification.
Exactly. And that's one of the biggest appeals of passive investing. You spread your risk across a wide range of companies, which can help reduce the volatility of your portfolio.
That sounds appealing, especially with all the talk of market ups and downs we discussed earlier. But is passive investing really gaining that much traction in India?
The report suggests that it's becoming increasingly popular here, and there are a few key reasons for that. First, passive funds typically have lower fees than actively managed funds, since you're not paying a team of analysts to pick stocks. Second, there's mounting evidence that suggests it's pretty tough for actively managed funds to consistently outperform the market over the long run.
So if you're not trying to beat the market, why not just go with the flow and potentially save on fees along the way? It sounds like a pretty compelling argument.
It is, and as more Indian investors embrace this approach, it's likely to have a significant impact on how money is allocated in the market.
Makes a lot of sense.
Yeah.
It's like a shift in the investing landscape.
Okay.
Let's go back to the report's sector analysis for a moment. They break down financial services into different segments. Can you walk me through that?
Absolutely. So they highlight private banks, public sector banks, non-banking financial companies, or NBFCs, and housing finance companies as key players within the financial services universe.
That's quite a variety, each with its own unique characteristics, I imagine.
Precisely. Private banks, for instance, have been the darlings of the sector for a while now. They've consistently delivered strong growth and profitability, attracting investors looking for a reliable bet within financial services.
But what about public sector banks? I know they've faced some headwinds in recent years.
Yes, they've been dealing with issues like high levels of non-performing assets, meaning loans that aren't being repaid, and the need for restructuring to become more efficient. But the report suggests that there might be a turnaround in sight.
Really? What makes them think that?
The report points to potential improvements in their financial health. It's not a sure thing. But if public sector banks can successfully navigate these challenges and improve their performance, there could be significant upside for investors.
So for those who are comfortable with a bit more risk, it might be worth keeping an eye on public sector banks.
Yeah, that's a good way to think about it. Now, what about the other segments like NBFCs, insurance, and housing finance companies? What's their outlook?
Yeah, I'm curious about those too. They seem a bit more under the radar compared to the big banks.
Well, NBFCs have been a very dynamic part of the financial services sector. They cater to a wide range of financing needs, but they've also been more vulnerable to liquidity crunches and regulatory changes. The report suggests that their future performance will really hinge on their ability to manage risk effectively and adapt to the evolving regulatory landscape.
So it's a bit of a mixed bag for NBFCs. It seems like they have potential, but also face significant challenges.
That's a fair assessment. As for insurance and housing finance companies, they're both tied to long-term structural growth drivers in the Indian economy.
Can you remind me what structural growth drivers are again?
Oh, these are essentially fundamental factors that are expected to drive economic growth over a sustained period. Think of it as the underlying engine of the economy. For insurance, it's the expanding middle class and a growing awareness of the importance of financial protection. For housing finance companies, it's the ongoing trend of urbanization and the aspirations of homeownership.
So these sectors stand to benefit from these larger societal and economic shifts.
Exactly. But remember, as with any investment, it's crucial to do your homework, understand the specific risks and opportunities, and choose investments that align with your own goals.
Okay, duly noted. Now shifting gears a bit. What's the overall outlook for the Indian market as a whole? Been getting mixed signals.
Well, the report paints a cautiously optimistic picture. It acknowledges the challenges, but also emphasizes the underlying strengths of the Indian economy.
So it's a bit of a balancing act,
Yeah.
like a scale tipping back and forth.
Yeah, that's a good analogy.
Yeah.
On the positive side, India has a young and growing population, a burgeoning middle class, and a government that's actively pursuing economic reforms.
Those are definitely positive factors, but I imagine there's some headwinds as well.
Of course, there are concerns about inflation, global economic slowdowns, and geopolitical uncertainties. All of these factors will likely influence how the market performs in the coming months and years.
So it's a complex and constantly evolving situation. It sounds like staying informed and being adaptable are key.
Absolutely. The market is always changing, and investors need to be prepared to adjust their strategies as needed. But before we wrap up this part of the deep dive, there's one more area I'd like to explore: alternative investments.
Oh, that sounds intriguing. Is this where things get a little more adventurous? I've heard about alternative investments, but haven't really delved into them.
You could say that. Alternative investments are essentially assets that fall outside the traditional categories of stocks, bonds, and cash.
So what are some examples of these alternative assets? What comes to mind?
Well, we're talking about things like real estate, private equity, venture capital, hedge funds, commodities, and even collectibles like art and wine.
Wow, that is quite a diverse range. From physical assets like real estate to financial instruments like hedge funds to tangible collectibles, it's like a whole different world of investing.
It is. And there are a few potential benefits that draw investors to these alternative assets. First, they can offer diversification beyond those traditional asset classes. They often have low correlation with stocks and bonds, meaning they might not move in the same direction at the same time. This can help reduce the overall volatility of your portfolio.
So like we talked about with healthcare, it's another way to potentially smooth out those market swings.
Precisely. Another potential benefit is the possibility of higher returns. Now, this comes with higher risk as well, but if you're willing to do your research and carefully select your investments, there's the potential for significant gains.
Higher risk, higher reward.
Yeah.
That's a familiar concept in investing, but I'm guessing these alternative investments aren't for everyone, right?
You're absolutely right. They often require a higher minimum investment, have lower liquidity, meaning it might be harder to quickly convert them to cash, and can be more complex to understand and manage.
So it sounds like they require more expertise and a higher risk tolerance.
Exactly. They're not for the casual investor. But if you have a long-term investment horizon,
Okay.
are comfortable with more risk, and are looking to diversify beyond stocks and bonds, then exploring alternative investments might be worth considering.
It's like leveling up your investing game, but you need to make sure you're ready for that next level.
That's a great way to put it. It's important to do your due diligence, understand the risks involved, and potentially seek guidance from a financial advisor who specializes in alternative investments.
Sound advice. It seems like we've only just dipped our toes into the vast ocean of alternative investment.
There's always more to learn, but I think we've covered a lot of ground today. From passive investing and its growing popularity to the nuances of different financial services segments, and even this exciting realm of alternative investments, it's been quite a journey through the Indian equity market.
I agree. It's been incredibly insightful, and I appreciate you breaking down these complex topics in a way that makes sense. But there's still one more topic I'd love to discuss before we move on. ESG investing.
Ah, yes. ESG investing. It stands for environmental, social, and governance factors. And it's definitely no longer just a niche trend.
I've been hearing more and more about ESG investing lately. but I'm still a bit fuzzy on the details. Could you shed some light on what it actually entails?
Of course. ESG investing is about incorporating environmental, social, and governance factors into your investment decision-making process. It's about looking beyond just financial returns and considering a company's impact on the planet, on
Yeah.
society, and how well it's managed from a governance perspective.
So it's like investing with a conscience, taking into account a company's values and actions beyond just their bottom line.
That's a good way to put it. And ESG investing is gaining traction for several reasons. First, there's a growing recognition that sustainability issues, like climate change, social inequality, and corporate misconduct, can significantly impact a company's long-term prospects.
So it's not just about doing good, it's also about making smart investment decisions
Yeah,
by recognizing these long-term risks and opportunities.
exactly. It's about aligning your investments with a more sustainable and responsible future. Second, there's a generational shift happening. Millennial and Gen Z investors are more likely to prioritize ESG factors when making investment choices. They want their money to reflect their values.
Yeah, they're putting your money where their values are. That's powerful.
It is. And their influence is only growing. So how can investors actually incorporate ESG principles into their portfolios? Are there specific tools or strategies?
That's a great question. It all sounds good in theory, but how do you actually put it into practice?
Well, there are a few different approaches. One option is to invest in ESG-focused funds. These funds specifically target companies that meet certain ESG criteria. So you're essentially outsourcing the research and selection process to experts who focus on this area.
That sounds like a good option for those who want a simplified approach.
Yeah, it can be. Another option is to directly engage with companies through shareholder activism or voting on ESG-related proposals. Investors can use their voice and their votes to push companies to improve their ESG performance.
So it's about actively using your ownership stake to drive positive change.
Right. It's about taking a more hands-on approach. And there are also various tools and ratings available to help investors assess the ESG performance of different companies. You can do your own research and make informed decisions based on those assessments.
So there's a whole spectrum of ways to get involved with ESG investing,
Mm-hmm.
from passive funds to active engagement.
Exactly. And the key is to find the approach that aligns with your own investment goals, values, and level of involvement.
I'm definitely seeing why ESG investing is becoming such a big deal. It's not just a trend. It's a shift in how we think about investing and the role of companies in society.
I completely agree. As awareness of ESG issues continues to grow and investors demand greater transparency and accountability, companies that prioritize ESG principles are likely to be rewarded.
It's like a virtuous cycle, where responsible behavior and good investment returns go hand in hand.
Precisely. It's about creating a more sustainable and prosperous future for everyone.
Okay, I think we've covered a lot of ground in this deep dive into the Indian equity market. We've explored market volatility, sector analysis, passive investing, alternative investments, and now the growing importance of ESG factors. It's been quite a journey, and I'm feeling much more informed.
It's been a pleasure exploring these topics with you, and I hope our listeners are feeling more equipped to navigate this dynamic and ever-evolving market.
Me too. But we're not done yet. We still have one more segment to go. In part 3 of our deep dive, we'll tackle a question that's been on everyone's minds. What's the future of the Indian rupee?
We'll be right back.
Welcome back to the final part of our deep dive into the Indian equity market. We've covered a lot of ground already, but as promised, we're going to tackle that big question lurking in the back of every investor's mind.
The future of the Indian rupee, where is it headed? What factors are kind of pushing and pulling it? It's a complex topic, that's for sure.
Yeah, for someone like me who's still learning the ropes, it can feel a bit overwhelming. So let's just start with the basics. How has the rupee been doing lately?
Well, it's been facing some headwinds against the U.S. dollar. We call it depreciation when a currency loses value compared to another. And the rupee has depreciated against the dollar by roughly 4% in the past year.
So that means one U.S. dollar buys more Indian rupees today than it did a year ago. So what's causing this depreciation?
Well, several factors are at play here. One major driver is the difference in interest rates between India and the U.S. The U.S. Federal Reserve has been raising interest rates to try and tame inflation, while India's central bank has taken a more cautious approach. This difference makes it more attractive for global investors to hold assets in U.S. dollars, which can put downward pressure on the rupee.
It's like a seesaw. When interest rates in one country rise, their currency gets stronger and the other weakens.
Yeah, that's a great analogy. Another factor is India's trade deficit. The country imports more goods than it exports, which means there's this constant demand for US dollars to pay for those imports. This also contributes to the rupee's depreciation.
It's all about supply and demand, right? Higher demand for dollars and lower demand for rupees puts downward pressure on the rupee's value.
Exactly. And on top of that, we have those global factors like geopolitical tensions, fluctuating oil prices, and the overall health of the US economy. All of these can impact how the rupee performs.
So it's not just what's happening within India, it's also about what's happening on the world stage.
Precisely. It's this constant interplay of forces, both domestic and international. Now, the question on everyone's mind is, what does this mean for investors?
Right? Is the weaker rupee good or bad? Does it help or hurt my investments?
Well, it's not so black and white. A weaker rupee can actually benefit certain sectors, like companies that export goods. Their products become more competitive in global markets when the rupee is weaker, because they're essentially cheaper for buyers using stronger currencies.
So there's like a built-in discount for international customers.
Exactly. However, there's a flip side. A weaker rupee can make imported goods more expensive for people within India, which can lead to inflation. It can also make it more costly for Indian companies to repay debts they have in US dollars.
So like with most things in economics, there are winners and losers.
Yeah, that's a great way to summarize it. It's crucial for investors to think about how currency fluctuations could affect different parts of their portfolio. But let's shift gears for a moment and talk about something a bit more positive. Remember those long-term growth drivers of the Indian economy we discussed earlier?
Yes, I do. We touched on this when we were discussing sectors like insurance and housing finance. What are some other key factors that could fuel India's growth over the coming years?
Well, demographics is a big one. India has a young and rapidly growing population, which translates to a larger workforce and an expanding consumer market. That means more people earning money and spending money, which is great for overall economic growth.
It's like a demographic tailwind pushing the economy forward.
Exactly. And we can't forget about rising incomes and urbanization. More people are moving to cities, joining the middle class, and having more disposable income. This further boosts consumption and creates really exciting opportunities for businesses.
So there's a huge amount of untapped potential in the Indian market.
There is, and the government is playing a key role too, through initiatives like Make in India, which aims to boost domestic manufacturing, and digitalization efforts that are transforming various sectors.
So it's a multi-pronged approach to growth, addressing
sure.
different areas of the economy.
That's right. It's about creating a more conducive environment for businesses to thrive and for the economy to flourish. And this has led to a surge in innovation and entrepreneurship. India now has a vibrant startup ecosystem, with new companies springing up in areas like technology, healthcare, and renewable energy.
It's like an incubator for fresh ideas and new businesses, fueled by this spirit of entrepreneurship.
That's a great way to describe it. And all these factors combined with India's inherent resilience and adaptability make it a really compelling destination for investors with a long-term perspective.
I'm definitely feeling that sense of optimism. But like you said earlier, no investment is without risk. So what are some potential challenges or risks that investors should be aware of when it comes to India?
That's a great point. You know, it's crucial to be aware of potential risks, even when the outlook seems bright. Some of the key risks to keep in mind for India include geopolitical uncertainties, potential regulatory changes that could impact businesses, infrastructure bottlenecks that might slow down growth, and persistent social inequality. These are all factors that could influence the market's performance.
It sounds like it all comes down to striking that balance between opportunity and risk, doing your homework, and being prepared for the unexpected.
Exactly. Investing always involves a certain level of uncertainty. But for those who take the time to understand the landscape, the potential rewards can be significant. India offers an exciting blend of growth and diversification for investors who are willing to embrace both the opportunities and the challenges.
I would just say this deep dive has been an eye-opening experience. We've explored so much, from market dynamics and sector analysis to the intricacies of the Indian rupee and the country's long-term growth prospects. I feel much more informed about the Indian equity market now.
Well, it's been a pleasure diving into these topics with you. It's a fascinating market full of complexities and nuances, but I believe that knowledge is power, especially when it comes to investing.
I couldn't agree more. And on that note, we've reached the end of our deep dive. Thank you for joining us on this journey through the Indian equity market. We hope you found it insightful and helpful.
It's been a pleasure sharing our insights with you. We encourage you to continue exploring the world of investing. and to always stay curious.
That's great advice. Until next time, happy investing.